السلام عليكم ورحمة الله وبركاته. الحمد لله رب العالمين والصلاة والسلام على النبي الأمين وعلى آله وصحبه أجمعين. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي آمين يا رب العالمين. So dear brothers and sisters, uh, today we'll discuss on asset allocation process. So here we'll focus on the portfolio management and also different strategies on asset allocation. And we also talk about IPS, investment policy statement, which is the first step to establish the relationship between the investment planner and the client. So, what is wealth allocation? So wealth or asset allocation is a very important process in the financial planning, and it is something is dynamic and continuous and not a one-off process. It will be done and it will be checked and balanced on a regular intervals, like every year or every 6 months. So when we talk about the asset allocation, so it means that where we will put what type of assets, how we will uh, diversify our investments. So we have a different classes of assets. So we want to choose which types of assets we will invest more, which type of assets that we will take less in our portfolio. So when we talk about this asset allocation, there will be two. Our discussion will involve two important components. First is the investment policy statement, which is the IPS, and secondly the portfolio management process. What are the processes related to this portfolio management in relation to the asset allocation? So first is the investment policy statement. It is a very important document that will establish the relationship between the client and the wealth planner, as well as the uh, the job scope and and it will take into consideration the client's objectives and his the constraint. So usually in a IPS, the client's return objective would be stated, and his risk tolerance over the relevant time and his time horizon, the time of investment, whether he needs whether he has any liquidity requirements during this period, and also the tax considerations, whether is there any what would be the approach to pay the taxes and regulatory requirements, such as like some other issues like Sharia requirement, those who want Sharia compliant investment. So here is an example to make it more clear. Like here, Mr. Juan, he's an individual investor, is 55, so his portfolio is individual and taxable from California. Okay, so his current asset is 500,000 and his return goal is 6%. So it is stated in the IPS in the document that will be signed at the beginning of this wealth management process. So he states that his return goal is fine with 6% return per annum, and he has a 1 year loss limit of 15 to 18% in worst case scenario. Means the portfolio should not have losses more than 18%. So in that, if 18 or more, the immediately the wealth manager needs to do something to rebalance to mitigate the risk loss. Okay, so after that we put the objective of the client. Like his objective here is a long term and growth. He wants his capital to grow and also capital preservation. So he wants his capital to be preserved. So he wants less risk. So based on that, we can say that he is conservative, his risk profile, because he wants capital preservation is for long term and he wants his capital to grow smoothly with just 6% return. And his time horizon is greater than 5 years, is for long, and he doesn't have any liquidity needs. And his return expectation is 6% based on the historical rates of return. And then the IPS will include the terms and conditions related to the duties and responsibilities of the wealth manager. So usually his duty, the wealth manager's duty is fiduciary, means is based on trust as amana. He will, based on good faith, he will advise for the best interest of the client. So and he will so his job scope here, he will select the assets in accordance with the asset allocation, providing sufficient diversification of risk and return. So based on the goals and expectations, he will allocate and then control and report all investment costs, monitor all investment options and portfolio custodian, and then value all portfolio holdings on a regular basis, maybe after 1 month, 1 year. Okay, so every provide monthly reports. So at the end of the month, he should provide the changes in the portfolio, the returns or losses or whatsoever. You should update to the client. So that is his job. And then here it will also state the portfolio selection guidelines. So here, based on in this IPS, in this example, we have to, because uh, here the client's um, um, risk appetite is a conservative, so we choose 60%, okay, for the 60% stock assets and 40% are on fixed. So the equity will be on US and then also on international markets, and including some developing markets, which is quite risky. And some fixed asset will be US bonds. And then there'll be terms on the rebalancing. The portfolio will be rebalanced annually while attempting to minimize the tax consequences of asset sales. So when we rebalance, of course, buying and selling of shares or securities will need tax payment in terms or need to pay the stamp duty in terms of buying and selling the shares. So the objective will be to minimize the tax payment, but at the same time they will try to rebalance to fulfill the goals. And then the performance, how the performance will be measured with so it is stated that each index mutual fund or exchange traded funds returns will be compared with their related benchmark. So they will be compared with their peers. Any deviation from that benchmark will be evaluated and discussed annually if there is a lack of performance. So they will discuss based on the comparison. Um, the parameters for selling a fund due to poor performance include 1 year or greater than 1% deviation from the benchmark and or falling in the bottom half of the cohort fund group. So if this if this portfolio falls under the below the falls uh, into the lowest 50%, so they will sell it or try to rebalance it. Or if it is there is a difference of performance of even 1% from his peer then they will think about rebalancing or selling of the fund. uh, so that was the IPS. So after the client and the wealth planner, they discuss and they sign on the IPS. So there will be the portfolio management process. So we talk about here the diversification of assets. So this is an integrated set of steps taken consistently to create and maintain an appropriate portfolio to meet the client's investment and other goals. So here we will focus on the diversification of the asset based on different asset classes, based on the modern portfolio theory, which is developed by Harry Markowitz. Of course, is not modern. Is in 1950s he developed this theory, but it is still called the modern portfolio theory. So so what this theory is all about, to make it short, is not to put all your eggs in one basket. So it is talking about diversifying. If we diversify, if we put our investment in different asset classes, so we can minimize our risk. So we can see that even from the pandemic of COVID-19, while certain sectors of business they were losing, while certain sectors or they were getting a lot of profit. So they are rising. So if we diversify, so if we put some on, let's say, on gold and put some on shares, so when the market crashes, so the gold will go up. But when the market is fine, then the shares will go up. So with this, we can, if we diversify, and then we can mitigate our risk. So this modern portfolio theory argues that an investment's risk and return characteristic should not be viewed alone, but should be evaluated by how the investment affects the overall portfolio's risk and return. So instead of just looking at the performance of one asset, we need to evaluate on the overall performance of a portfolio. So that will be better. Maybe someone got a lot of profit from one asset, but he lost in another asset. So it's better to look into the performance of the portfolio. Okay, so based on this theory, the portfolio theory, when we want to diversify, so first we look into the opportunities or the types of the asset classes that we have. So if we look from the Sharia perspectives and in the context of Malaysia, so we can see more or less these 7 types of asset classes. So starting from the Wadia, so the number one is the most liquid, and yeah, most liquid, and also the less risky, with of course with the low return. Like Wadia saving account, generally it gives around 3% return, but with if Wadia, the capital is guaranteed. But if Mudaraba investment account, here the capital is not guaranteed. The depositor needs to share profit and loss, but the return can be higher. It can be 3% and above, um, and uh, it should be a bit long. It has some kind of conditions, like investment cannot be withdrawn within 6 months or 3 months, comparing with the Wadia saving account where anyone can withdraw at any time. And the second one is the Islamic money market instrument. While this cannot be done by retail investors, but it can be done through mutual funds, okay, through a pool of investment. So Islamic money market is almost similar to the Wadia, but it has higher return than the in saving account, and it is also it has low risk comparing with shares and sukuk, but a bit higher risk than the Wadia saving account. And then sukuk lies at the middle. It actually sukuk is investment certificates that, and that's represent ownership in a project or in an where usually in a big project, the government or sometimes corporations, they will issue sukuk. So it can be said the alternative of the conventional bond. However, the sukuk, the risk is a bit higher than the conventional bond, and sukuk mostly does not guarantee the return. However, there are mechanisms that from that's approved by the Sharia scholars that allow the sukuk issuer to pay a consistent return to the sukuk holders. So here the sukuk, we can say that it is the risk is at the middle between shares and what their saving account. It has risk, but sukuk is good that in terms of consistent return and lower return. Like in the context of Malaysia, usually the return for sukuk is around 5 to 6%, based on my experience of a few years of investment. And after sukuk is the halal shares. So the halal shares are the shares which uh, the companies that gives benefit to the society, and they do not have a high leverage or debt. The debt are not more than 33%, and they don't have uh, non-halal income or interest-based income more than 5%. So these are the halal shares. Usually the uh, Securities Commission Malaysia, they will list down the halal shares. So the shares are the risky assets, and also it has a different classes. We have big companies which are less risky compared with the small companies or the companies that are growing. So share is quite volatile as well. The returns, and we need to know also a background of the companies, and sometimes we need to we need to understand the economy, and also the business environment, or even sometimes the government policies that also can have an effect on the companies, so that and it also ultimately will change the share price. And after, so when we talk about shares, we also have something called ETF. ETF is it to make it easy to understand. It is like a basket of shares or a basket of asset, but it is also traded in the share market. So when if in order to mitigate the risk in investing in one share, it is better to invest in ETFs, because ETF usually will buy a basket of shares, let's say 50 shares of an from okay, from one company. Like in Malaysia, we have Islamic Dividend ETF. So that will hold the 30 top companies in Malaysia. So if we buy the share of this ETF, or one okay share of this ETF, means that that represents the 30 top companies in Bursa Malaysia. So which has a lower risks based on the portfolio theory. So that's we can have higher profit, but while we can mitigate the risk. And Islamic REITs are similar to the mutual funds, where we can pool a lot of money into one fund and they invest. That is the mutual fund. And when that mutual fund is investing only in real estate investments, so then we call it REITs. So REITs is the short form of real estate investments. So the REITs is different from the physical real estate investment, where physical real estate investment is very illiquid, and we need time to buy the physical asset. There are a lot of procedures, but the REITs is they just pull funds from a lot of investors. We can just pay money, and then the fund manager will invest in real estate investments. When they can make condo and rent out. So, and it is very liquid. We can anytime we can sell off our shares. And after that, we have another asset class is the precious metal, which is also uh, very important, popular. Like gold investment has been very popular in Malaysia. We have like public golds and some other golds, and we can see the changes of gold investment is almost comparable to shares, but it takes time. Like if you buy gold 20 years ago, the return would be double or triple, or can be same like the return of a share market. We can see like in 2000 the gold one gold dinar, which is 4.25 gram, it was around 160 ringgit. But right now, the price of gold, one gold dinar is 1,100 plus. So in this 21 years, we can see the price of gold increase almost more than 3 times. So similarly, also we can invest in silver or platinum, or there are some futures or traded and which are Sharia compliant futures in the Bursa Malaysia. The underlying asset is the silver, platinum, or others. So which are also risky, but at the same times also it can give us return. However, some of them are very illiquid. We go for the physical asset. So after we know the asset classes, we also go more deeper on the shares. As I said, in the shares we have a large cap stocks, which is in the US. If a company is has a market capitalization of more than 10 billion, is considered large cap, and then middle cap is from 2 to 8 billion, and small cap is less than 3 billion. In Malaysia, we have a main market in the Bursa Malaysia. The main market is that will list the big companies like Tenaga Nasional, TNB, Petronas, and others. And and we have the AC market, which will list the small companies, and that we have LEAP market that also will list the small companies, and especially the entrepreneurs. That's the new company just growing, and which is very risky. So with this we can also diversify our asset in investing in different types of stocks, and also we can invest in international securities like securities issued in the US or in China or in Indonesia or other countries. We have stocks in emerging markets, means where the countries is just growing, is a developing countries, is a new market, so it's a high risk but with a higher return. And then this is also the different sectors of investment that's developed by S&P and also MSCI. They have 11 types of sectors for investment, like information technology and healthcare. So information technology is companies related to all the IT related business, the computers, and like Microsoft, all these come under Microsoft, Oracle, all these come under the information technology companies. The healthcare business, in Malaysia, we have IHH, which is the one of the top healthcare companies in Malaysia that owns Gleneagles and others. And we can see, and also the glove makers like Kosan, Hartalega, and Top Globes. These also come under the health care, and we can see during the pandemic, these two sectors they develop, they grown up sharply. Their share prices skyrocketed, and the financials they grow smoothly. They are mostly stable, means the banks, takaful companies, consumer discretionary. They are usually the luxurious items that for people to use, and also online businesses. Even Amazon comes under consumer discretionary. I think Shopee all come under consumer discretionary. Communication is the communication related company, and the social media like Facebook, the newspapers all come under the communication. So this sector also quite developed during pandemic, like we can see in Malaysia, DG or Axiata, the Celcom, TM, their share prices also skyrocketed during this time of pandemic. The industrial products, the manufacturing products, so the products that we get, so they are also quite stable. Okay, like the chip makers, car makers, they are come under the industrials. Consumer staples are the main foods that people need, like the producer of rice, or we can, I think palm oil can be under consumer staples. And under the consumer staples, I think can be the Hapseng in Malaysia. The energy are oil and gas related companies. The utilities are like the TNB, uh, electricity, water providers, Satu and others. They are listed. Real estate, we can give example of like Sime Darby, Sunway. They are investing in construction. And materials are the raw materials like aluminium or tin, or the production, the companies, which are producing this kind of materials. They are actually the raw materials like steel, producing raw materials for others. So these are also a way that we can diversify our asset, because different times, different sectors rise, different sectors go down. So if we have stocks that can cover different sectors, so we will be less vulnerable to different types of market crash or economic situation. And after we know the asset classes and different sectors of investment, we need to set our capital market expectation based. Usually, people set the expectation based on the historical data, but we need to be careful. There are a lot of people, they talk about the what we call the technical analysis, which is based on the historical data. But we should not rely too much on the historical data, because uh, yes, that we need to consider, but the historical data, some we do not know the situation in that time. Maybe there, what was the economic factor, the environment may have changed. See, if we look at Air Asia right now, okay, so they couldn't imagine that they will face this situation in this pandemic. But so the historical data cannot give us any, couldn't predict this situation. So we need to also understand the economic and also the outlook of the industry and others. Then asset allocation strategies. So how the assets allocation will be like monitored, and how the balance should be. It is also important. So let's give you an example. Like here, let's say Mr. Joe is the process of creating a financial insurance for his retirement. So he is planning an investment for his retirement. So he wants to invest 10,000 saving for a time horizon of 5 years. So his financial advisor may advise Joe to diversify his portfolio across the three major categories at a mix of 50, 40, and 10. So 50 is a stock, 40% is bond, and cash is 10%. So this is the asset allocation based on his goal. So 50%. So we can say he's moderately aggressive investment, because 50% in stock. So example, so even in the stock, 50% it goes to 20% to small cap growth, the new companies that growing, and then 50% only on large cap value stocks, on big companies that's quite stable, and 10% on international stocks. So mostly he's going for higher risky stock. And bonds, 50%, 15% on government bonds, and 25% on high yield bonds, that is actually higher risk with higher return, mostly by the corporations, and 10% on cash or money market instrument that is liquid and also will give lower return. Uh, so now, when he has done his this asset allocation, the portfolio, then how will be the monitoring? What will be the strategy of this allocation? So there are different types. One is the constant weight asset allocation. So this one is very strict on the measurement. So that's what we have just what have decided just now, that 50% of stocks or 40% of bond. So this type of strategy, it will follow the follow that principle strictly. So the constant weight asset allocation strategy is based on the buy and hold policy. That is, if a stock loses value, investor will buy more, because if the percentage of share goes down, he will add more share to make 50%. And if it increases the price, he will sell. If the share value goes more than 50% in that portfolio, he will sell it off. So the goal is to ensure the proportion never deviates by more than 5% of the original mix. So the goal here is to follow the proportion. And however, unlike that one is the tactical asset allocation. So here they more concerned on the maximization of the profit of short-term return, and they will have lower concern on the proportions. It's a flexible in terms of the proportion, how much should go on stocks or how much on the bonds. Another one is the insured asset allocation. So this one is more focused on the insurance or on capital preservation, where they will it is involves setting a base asset value from which the portfolio should not drop from. So they will make a value that they should not get loss of this amount, or their losses should not go more than this percentage. If there is a drop, they will rebalance it. So this is more on the called insured asset. So it's more on the preservation of asset. But the most familiar one is this one, is the dynamic asset allocation. So it is flexible on the proportion. The dynamic asset allocation is it enables the investors to adjust their investment proportion based on the high and lows of the market and the gains and losses in the economy. So they are a dynamic one. They will change the proportion based on the changes in the market. So when there is, let's say, COVID, so they will more focus on technology, on healthcare or communication or sectors rather than on tourism sectors, for example. It is the most famous one, and it is a dynamic asset allocation strategy. So here is some of the examples. So here is a conservative portfolio because more assets put on fixed income like sukuk, or we can say bond, and only 20 or 15% equities. This one is moderately aggressive, where 50% equities, but and 35 to 40% on fixed income. So fixed income, it has lower risk with lower return but consistent return mostly. And cash is 5 to 10%. And this one is a very aggressive, where 80 to 100% on equity, cash is almost 0 to 10, and fixed income also between 0 to 10. So this is the very aggressive portfolio. This might be suitable for young investors and those who have uh, a big amount of money, so that they can cover the loss, rather than those who are at elder age, or who have less money to invest. And here is a very important concept, is called the dollar cost averaging. So this strategy of investment is that someone will have every month fixed like 500 or 1000 ringgit of Malaysia for investment. So he will not care about the market situation up and down. So he will fix one amount, and then he will buy the securities every month based on the that's fixed allocation. So let's say he puts every month 1000, and then if the share price goes up, is expensive, he will buy less. If it is cheaper, he will buy more. So this is a dollar cost averaging is suggested for those who are the beginners who have less amount of money to invest, or those who are saving. So it is better for them to go for this dollar cost averaging, where you just put a fixed amount of money every month to buy some securities, and it is usually for long term. Okay, so after that is the manager and the fund selection. It is very important to select the right manager and also the right fund. As we know that it happened in Malaysia, there are instances of breach of trust. Even there are instances that the fund become non-Sharia compliant. There are instances that the fund manager misappropriated the fund. So the first thing I would suggest is the trust. The trust is very important in order to choose the fund manager. So we can see based on their reputation in the market. We need to consider the fees, how much fees they charge. So mostly now people the the mutual funds or other because of using the technology, some of the fund managers they can reduce the fees a lot, but then again we need to compare with other factors as well. The return, of course, we will all of us will see the invest expected return based on their performance, and also the volatility, the risk that will impact on our investment, and also the investment approach, means which market they're going to invest, what type of assets, and whether they are Sharia compliant investment or not. That is also our concern. The liquidity, is it whether it is easy for us to withdraw the money or not. The liquidity issues, and some legal issues, whether if there is any breach, whether we have any insurance on that, if there is a loss, or whether any legal support. So these the terms and conditions, how clear it is, and the support from the regulators is also important in terms of the choosing the right fund manager. And under the fund manager, we sometimes have different funds. So that's also the best approach, similar to the fund manager. There is approach is called analytical hierarchy approach. So that is the approach where we set our goal, and then based on their goal we try to find out the criteria, and then we choose. Like if you want to buy a car, so you want to buy objective is to buy car. So in order to buy car, we have some criteria. We think about the cost of maintenance. We think about the comfort. We think about the durability, and also we think about the consumption of petrol. So these are the criteria. Similarly, in fund selection, we can also see what are the costs, what is the return, okay, what is the liquidity, and the volatility, the risk related. So based on that criteria, it is a systematic process to choose the best fund based on the objectives and the criteria mentioned. So if we take this systematic approach, so it will prevent us from making any inconsistent difference, and it will be more objective rather than subjective, and it will minimize the investors inputs as well. Some also they use the software to detect as well the best fund for the client based on uh, the client's goals. So that's all on the investment strategies or asset allocation. So we have already discussed today how to uh, what is the how to write the IPS investment policy statement, what will be the components, and then we have discussed the asset allocation strategy, the types, choosing the types of assets, and how the diversification should be done. And this is just an introduction. While The further discussion will be done in portfolio management course. I hope with the calculations and others to go more details. While it was just an introduction here. So with that, I thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.